Hello, everyone. This is Zak Gardezy. I'm the founder of Wealthstone, which is a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So, I wanted to make a video on the topic of alternative investments. This is a phrase that you're hearing a lot more. And really, over the last few years, alternative investments have become extremely popular. I'm going to focus on three of the top alternative investments that I talk about with clients and that I hear about, which is private equity, private credit, and private real estate. I'll talk about what those mean for investor portfolios, why do investors include them in their portfolios, and then I'll also talk about pros and cons of these types of investments. So let's get right into it. Okay, so to kick things off, one thing that you should be paying very close attention to is the qualification for alternative investments. Not every investor is qualified to invest in them. So there's a couple of common qualification standards that you hear about. One of them is the accredited investor status. So in order to be an accredited investor, you have to have a net worth of at least $1 million or $200,000 if you're single, or $300,000 of income if you're married over the last 2 years in order to qualify as an accredited investor. So $1 million net worth, or $200,000 of income if you're single, or 300,000 if you're married over the last 2 years. Now, the net worth figure excludes your primary residence. So remember, it's a $1 million net worth excluding your primary residence. Then there's another qualification standard that you hear about, and this is the qualified purchaser standard, which basically for an individual boils down to a $5 million net worth. Uh, as the qualification standard for being a qualified purchaser. Now, your financial advisor or whomever you're discussing, investing in alternative investments with, should explain to you whether or not, this particular investment requires you to be an accredited investor or a qualified purchaser. And you might be wondering, well, why are there even these restrictions or standards around who can invest in these types of assets? It mainly boils down to some, really classic rules about, you know, depending on your level of net worth or income or just overall assets, you may have the resources to hire a financial advisor or a lawyer or a CPA or somebody to walk you through these investments, which are not public, which are typically a bit more difficult to digest and understand than, for example, investing in a Apple stock or Microsoft, for example. So that's generally why you have some of these restrictions in place. It's very important to remember that, because not everybody is qualified to invest in these types of investments. So let's talk about private equity. Private equity is basically, it's investing in companies that are not traded publicly. They're not publicly traded companies. They're not on the stock market. And the world of private companies is actually larger than those of the public market. So what you ultimately have is a larger basket of companies to choose from, but it's not like trading in public stocks where you can choose which private companies to invest in. There are platforms out there that are sort of democratizing this process a little bit, but there's a lot of, fine print that you have to read into before, you invest in those types of strategies. And again, work with your financial advisor to see if those even make sense. So, but overall, investing in private equity is investing in private businesses. Now, the stages of those private businesses vary significantly. They could be very early stage, venture capital type investments. They could be later stage, buyout type stage investments where these companies are going to IPO or merge with other companies or be sold off by the private equity firm, whatever it is. Those could be those later stage investments. Or you could have a fund that invests in, sort of a diversified pool of different stage private equity investments. But, investors often ask, well, why do people invest in private equity? What's the value behind it? One of those is typically the private equity investments or those managers, they want to provide good returns. They want to provide equity like returns or greater. You are going to, tie up capital for a period of time depending on how the private equity fund is structured. It could be those newer type of funds that you see these days where they have sort of a quarterly liquidity window where they say, hey, look, you could request to get funds out on a quarterly basis. The important thing to remember there is you're requesting, it's not guaranteed. There's a lot of rules as to how much money can come out of those funds. And if there's some distress happening, whether at the fund level or economic level, they could prevent redemptions from happening. So you have to remember that. Or there's those traditional private equity funds where capital is locked up for 5, 7, 10 years or longer. So you have to work with your financial advisor to see, what's the return profile on this private equity investment? What's the risk? How long is capital being tied up for? What are the fees? What are your expectations? And, you know, if we're going to fund this investment, what about, my sources of income if you're retired? Where should that come from while money is, tied up in this investment for a number of years? So, but nonetheless, there are those expectations of growth, of course, in private equity investing. There's also the risk factor or the correlation component that you should be considering when investing in private equity. So think about it like this. If you're investing in stocks or just in equity in general, right? You're typically investing in, let's say, US stocks, Apple, Microsoft, Nvidia, Alphabet, etc. You could potentially buy more of those stocks and get further exposed to the public stock market, or you could diversify your portfolio somewhat by investing in private equity. And the reason why I say somewhat is because it's not like private equity is completely decorrelated from the public stock market. The correlations are actually on the higher end, but it's not a one for one in most cases. And in a lot of cases, you do get some diversification value by investing in private equity. So there is a lot of value in exploring private equity funds, but you have to remember to do your due diligence, or your financial advisor should, on which funds to invest in. No single fund is made the same as the other, and the managers are all very different. Your Blackstones, your KKRs, Apollo, and there's many others. Vista. There's so many other managers out there. Some are top tier, high quality managers, like many of those that I just listed, and then some are newer entrants, maybe lower tier managers out there in the marketplace. Doesn't necessarily mean that they have bad funds or you shouldn't invest in their funds, but again, the expertise and the due diligence required to figure out if those are potentially good investments, it's very critical. And that's part of the reason why, as I mentioned earlier, there are those rules around accredited investors and qualified purchasers, because in a lot of these cases, you really need to do your homework as to whether or not this particular private equity fund is a good one or a bad one, and be confident in your decision. But investing in private equity could be quite rewarding, but again, you do want to make sure you do your due diligence before you invest in any of those funds. So, private credit is a very interesting field. It's grown significantly. And if we really think about this multi-trillion-dollar part of the economy now, we really should take it back to where did things sort of blossom in the private credit space? So, back in the GFC, the Great Financial Crisis, 2008, 2009, during this period where, banks were failing and banks were taking on a lot of risk, a lot of bad risk on their balance sheet, banks made the decision to step away from certain types of customers. One of those, predominantly, was middle market businesses. So these are, not, your small mom and pop shop business, and not your super large mega corporations. Your small mom and pop shops are really served predominantly by credit unions and regional banks, and the national banks, they serve a lot of the really large corporations. But then there's this middle market, which was really ignored over the last 10 to 15 years or so. And this is where private equity firms stepped up and said, hey, look, we've got a lot of capital on the books. Why don't we become the lenders, create these types of private credit investments where people can invest in our firm. We do the underwriting. We basically act as the bank, and then we lend money to private corporations. And then we potentially charge higher rates than what banks would. We could structure our own custom contracts and covenants to try and create more security in these loans for our investors. And then we could also do things like, determine where in the capital structure our loans are. So in case those companies become insolvent, we know we potentially get paid back first. There's so many different things that private credit lenders can control to where it might be easier for a company to borrow from a private equity firm than it would be a traditional bank. And then it just might be a little bit more expensive for them to do so. But as an investor in this space, you want to be thinking about, well, why would you invest in private credit? A good reason is if you go back to 2022, let's say you had the traditional 60/40 portfolio, 60% stock, 40% bonds. Your 40% bond piece was probably mostly fixed rate bonds. Now, for many years, that was a boring part of your portfolio, probably didn't return much. But in 2022, probably got hurt quite a bit when the Federal Reserve began raising interest rates. Well, then when you look at private credit investments, a lot of them are floating rate private credit investments. So what that means is if the Fed raises interest rates, the income that you expect to receive in those investments could increase. If the Fed lowers rates, the income that you expect could come down and likely would come down. Now, from a asset standpoint, this is very different than what happens with fixed income type investments. In fixed income, if rates go up, your bonds actually lose value. They become less attractive to the overall market. If you tried to sell it, somebody or the buyer would want a lower price for your bond potentially because they can just go out and buy higher rate bonds actively in the market now that yours would have to be sold at a discount. That's why your bonds go down in value if rates go up. The opposite holds true. If rates go down, your bonds might actually increase in value. So there's this component of sensitivity to changes in interest rates with your traditional fixed income bonds. Whereas on the private credit side, specifically the floating rate private credit investments, they're not as sensitive to changes in interest rates from a pricing standpoint. Now, again, the income would likely fluctuate depending on what happens with rates, but this mitigates some of the risk that we saw in 2022 with the Federal Reserve raising interest rates rapidly. And so for some investors, we saw a lot of private credit investment happening after 2022. A lot of portfolio managers said, you know what, we want to mitigate against this risk in the future. Let's start adding some private credit into the portfolios. The interest expectations on those investments are still really high. I'm seeing a lot of 10% private credit funds. So, they're estimating to pay out or have paid out a 10% income yield, which then brings you to the point of, well, what account type do you want your private credit investments inside of? So, for example, if your private credit investment is in your trust account or a taxable brokerage account, whatever income that you generate is likely going to be taxed at your ordinary income tax rates. So depending on, what your tax rates are, federal and state, it's likely in not the right type of account for you to be holding private credit investments inside of, whereas IRA accounts could be a lot more attractive to hold your private credit investments because the income that you generate in those accounts are tax deferred. So you can generate as much income as you want in those accounts, and you get taxed typically when you take money out of your IRA account. So again, it's very important to focus on the types of private credit you want to invest in. Do your due diligence on the manager. Make sure you work with somebody, an advisor, a lawyer, a CPA who has a lot of experience analyzing these deals. So then you could determine which fund makes the most sense for you. No two private credit funds are the same. But beyond that, you also want to look at, can you handle the illiquidity of it? How is the liquidity structure? Is it quarterly? Do you have to hold your money? Do they hold your money for a number of years? Does that trade off make sense from a return standpoint for you? Does it make sense from a lifestyle standpoint? And then also, determine which type of account should you do this investment in and what makes the most sense for you. But overall, private credit could serve as a valuable diversifier in your portfolio, but just like private equity, it's very important to do your homework to see if that investment makes sense for you. Lastly, I want to touch on private real estate. So, there's a lot of investors out there who enjoy investing in real estate, whether it's in single family homes, multifamily, commercial real estate, and they wish that they could invest in those types of assets using their retirement funds, whether it's your 401k, your IRAs, or any sort of your Roth accounts, your retirement funds in general. Now there are, these types of self-directed IRA accounts that are out there. A lot of it's sort of, gray area, questionably legal in how those are set up. I'll leave that up to attorneys and those who have to deal with the litigation of those types of accounts. But the more legitimate way that I would say that you see a lot of real estate investing happening inside of retirement accounts is by investing in a private real estate fund. Now, a lot of the more public ones that you hear about are called REITs, real estate investment trusts, but there's private versions of these as well. Now, your public REITs, they typically trade on an exchange, New York Stock Exchange, for example. When they trade on exchanges, they have exchange risk. So what that means is, with algorithmic trading and a lot of this, computerized trading that goes on these days, if there's a major sell-off in the markets, right, and the algorithms decide to just sell everything, typically what you see is you see public REITs also sell off. And that really doesn't make a lot of sense because, you know, for example, if there was tariffs placed on, we'll just say Germany, for example, what does that have to do specifically with a public REIT that invests in multifamily homes in California? Not a whole lot, but you may see that public REIT just start selling off just because that's what the computerized trading systems are doing. So, private REITs, they do eliminate that exchange risk that you see. But in addition to that, there's a lot of interesting benefits that you get by investing in private real estate funds as well. So, for example, a lot of those same tax deductions that you get by investing in real estate directly, you get by being a limited partner in a private real estate investment as well. In some cases, depending on the type of private real estate fund, you can actually know what types of physical properties you are investing in. It's pretty cool to have some sort of oversight or some sort of feeling of ownership without having to actually do all the work, all the maintenance, finding the tenants, managing it all, getting those late night phone calls. So you can maintain a similar level of commercial real estate exposure, multifamily exposure, single family rentals, depending on the types of funds, and let a professional management firm do a lot of that work for you. Attractive income yields typically is what you can see in some of these private real estate funds. There's also the growth potential, those real estate values increasing. And then there's also many different types, as I mentioned, of private real estate funds. There's some really interesting ones out there. For example, like triple net lease type private real estate investments where a corporation will sell a commercial property to the private real estate firm. The private real estate firm becomes the owner, and they turn around and they sign a triple net lease with the seller of that property, the big corporation, and they say, "Hey, look, let's sign a 20-year lease or 15-year lease. Let's throw some inflation riders in there. You've got, excellent corporate credit rating, so we feel really good about this long-term lease." And then our investors in this fund can expect a consistent income distribution from this type of investment, probably pretty tax efficient as well. Now, in the context of an overall portfolio, you would want maybe some private real estate in your portfolio because it diversifies you further from stocks, bonds, private equity, private credit, and all the other things that we've talked about. So, when you're building out an overall diversified portfolio, it may make sense to have some private real estate exposure in there. The clients that I see that are most attracted to private real estate investments are those that, value the concept of investing in real estate overall, but maybe as they get closer to those retirement years or already retired, have absolutely no interest in actually being a landlord, which I don't blame them for that. It's a lot of work. And so then they invest in private real estate funds as part of their diversified portfolio. But just as I mentioned in the other segments, manager due diligence is extremely important here. There's so many different private real estate funds out there. It's important to work with a financial professional, whether it's your advisor, CPA, or lawyer, whomever, to really do the due diligence on whether or not this particular private real estate fund, as I mentioned before, is a good one, a bad one. What are the strengths, the weaknesses, and for any of these investments, you really want to focus on the costs, the liquidity aspect. What are the risks? The managers, what's their track record? You want to look at all of these things before you invest in those particular funds. Now, what I do for clients at Wealthstone is I do a significant amount of due diligence in the alternative investment funds that I invest my clients into. In many cases, I meet the managers. I go to their headquarters. I've flown out to the headquarters of many of these private equity firms, in some cases, multiple times. and met directly with the teams that are managing some of these funds just to really figure out, how are you investing the capital? What's your strategy? What's your outlook? Does it make sense to me? And then if it makes sense to me, is it something that I could explain to my clients and really understand that particular type of investment? But when you build out an alternative investment portfolio for your clients, or as an investor, when you build this out in your portfolio, the goal is to diversify yourself from just public stocks or public markets, maintain those growth and income expectations that you've had in your portfolio, and really build out, a more tax efficient and diversified, high quality portfolio, and managing the liquidity, managing the taxation of everything, as I mentioned earlier. Those are all of the moving parts of building out a diversified portfolio with alternative investments. And when you do it correctly, you could theoretically lower the risk of your portfolio, and in some cases, even enhance your overall returns. And so, hopefully, you found this video to be very helpful for you, going into specific details about, the different types of private investments that we see most commonly. But then, if you want to go into more specifics about specific funds, strategies, managers, please don't hesitate to reach out. I'd be happy to have that discussion with you. And as always, if you have any questions, please feel free to reach out. Thank you very much.